One of the big hurdles for mass adoption of crypto is the hurdles to be removed so that big players can move in and out of crypto in ways that they're used to. Those bridges have to be built and be ready to go before institutions and sovereign wealth will come in with larger funds. One of the companies building a very important bridge is DeFinity. You know DeFinity because Paul from DeFinity joins us every Wednesday for price analysis. Today, Manu Chowdhury, CEO and co-founder of DeFinity, joins us to share some of that news. Welcome to the Crypto Rain channel and our family. Now, if you're looking for crypto news without context, or you're looking for panic selling and FOMOing in, you can find that in a lot of other places, but not here. If you, like me, came into crypto because you realized the potential for life-changing gains over a 4 to 8 year period, and you're looking for discussions on becoming a solid and shakeable crypto investor, you're in exactly the right place. Well, we do have a special guest today, and I'm really excited to have him on to share a little bit more about what DeFinity is doing. Help me welcome CEO Manu Chowdhury. Boy, Manu was not a name I had run into before, so sometimes it doesn't flow so easily off my lips, even though we've known each other now for 2 years.
Yeah, bet. Hey, Jay, how you doing?
Fantastic. Thank you so much for joining us. For those, there are some in the audience that they might have seen Paul for like up to 2 years now, but could you share with the audience what is DeFinity and what does DeFinity do?
Yeah, sure. Let me give you a little bit of background on me as well, just to give, I guess, people that are not familiar with DeFinity or me a bit more context. So I'm Manu Chowdhury. I'm the co-founder and CEO of DeFinity Markets, and essentially DeFinity Markets is a electronic trading venue for funds, for banks, and for also institutional investors for digital assets, so crypto, but also fiat on and off and fiat to fiat. In terms of my background, before I joined fintech, I spent about just under 18 years working in cross-asset derivative sales, working for a couple of UK investment banks. So most recently, Lloyd's Financial Markets, and prior to that, Barclays Investment Bank. And essentially, one of the biggest attractions for me to join the world of fintech was really seeing the evolution in 2017 of digital assets. And essentially, when the penny dropped about the uniqueness of Bitcoin, i.e., the first time that humans had created digital signatures that couldn't be forged, it was very obvious to me that this was just the beginning of something pretty huge in terms of the transition from, I guess, traditional finance, or TradFi, as everyone calls it, to a digital ecosystem. So one of the founding principles that we really had for the business was to have a more open, more accessible, and more transparent financial markets for every single institutional participant. And if you know anything about the institutional market for foreign exchange, which is really my background, you'll understand that there's a lot of credit counterparties, there's a lot of intermediaries, there's a lot of ways of taking credit risk and offsetting that risk. With the digital asset market, because it's so young and so innovative, that doesn't exist. So what we did, or our USP, is we are the first firm in the world to partner with an investment bank and to allow you to trade digital assets without counterparty risk. So in essence, what we have is we've separated trade execution from custody of fiat and custody of digital assets. So if you have a portfolio of bonds, you can place that with our partner bank. And again, I think we're the only people who can do this. And you can, within 20 milliseconds, trade on our platform. When it comes to the crypto assets, you either have them in self-custody or use a credible custodian, such as a bank in New York Mellon, or a State Street, or a Fidelity Digital Assets. So what this allows counterparties to do is allows counterparties to essentially trade crypto that otherwise would not be able to. And the main issue we've had since the FTX collapse, which again was a concentration of trade execution and custody, is that a lot of the asset allocators that give money to fund managers have said, look, you can trade whatever you want to trade, but the reality is you have to face a credit-worthy counterparty, i.e., does this counterparty have a Moody's or Fitch or S&P credit rating? And the answer is nobody does. But the bank we're partnered with actually has a AA minus credit rating. It's got a $1.5 trillion balance sheet, and most of the asset managers are already connected. Now, you may think, look, why is this relevant to the world of crypto? And the simple answer is, if you look at the assets under management in the world of asset management around the world, it's about $130 trillion. So there's about 21 fund managers that manage more than $1 trillion. There are 3,000 fund managers that manage between $100 million and $1 trillion. And there's about 12,000 below $100 million. These are huge numbers. Imagine that you saw them allocate, I don't know, 1% of their AUM to Bitcoin. You would double the market cap of Bitcoin overnight. And that's if they do 1%. Imagine if they did 5%. And that's kind of what we're trying to create. We're trying to create the accessible market conduit for these traditional finance institutions, who, by the way, have all got an interest. And I want to make an exception to a couple of these guys. So obviously, let's think about people like BlackRock and Fidelity, and also Vanguard in a slightly different way. These guys are behemoths. They're so enormous. They're big enough and ugly enough to do whatever the hell they want to do. They are not the norm. You have thousands of other fund managers that want to get into this marketplace, but they're unable to. And what we've allowed them to do through our mechanism that we've created in partnership with our European investment banking partner is a way for them to access this market in a safe way where there's no counterparty risk. Now, one of the real bits of innovation that we've done here, so let's say you have a market maker who's making prices and a consumer, let's say a fund manager. If, for instance, one of those counterparties doesn't settle the trade, if you're on let's say an OTC desk, you're a little bit screwed. If you're on exchange, you have a problem. With us, we don't, because we have the legal recourse to go into their account to make the other side whole. So no one ever loses in our ecosystem. So we've genuinely mitigated counterparty and credit risk. So, and by the way, this is not something that's happened overnight. We've been working on this for now 2.5 years or so. It's been very challenging and very difficult. As you can imagine, banks publicly are clearly very anti-crypto. Privately, they look at it as a new asset class, and they are seeing the big shift. And I've got to be entirely honest with you. The biggest driver of this has actually not been our contacts in sales and trading. It's actually been the guys on the bond origination desk. So you may or may not know, but last October, UBS Bank were the first bank to issue a digital tokenized bond. And this was the first bit of the innovation. If you know anything about how banks work, the guys in the capital market side, so the guys that work in proper investment banking, they're the guys that make the biggest risk-adjusted return for banks. It's not, sadly, the guys like me that take credit risk and counterparty risk with clients on the sales and trading side. Sadly, we're the pariahs of the investment banking club. But the proper investment bankers, the proper Wall Street heavyweights, and the guys in the City, London, and Canary Wharf, those guys, obviously, they look at this and think, okay, we make our money by issuing bonds. How do we do this? Well, we take a client, we take their details, we work out roughly what a credit threat should be. We then underwrite the issuance, and then we sell it down to a syndicate of 20 or 30 other counterparties. The problem is, or the issue for them, is that when you have a digital bond, you don't need a bank anymore. You can do it yourself. And this is exactly what Siemens did in March of this year, which I think the whole market thought, oh shit, this is a problem. So suddenly everyone's running at 1,000,000 miles an hour to say, right, the only way we're going to hang on to these very, very lucrative, very fat margins is if we do it ourselves. And that's exactly what's happening. So if you Google digital capital markets, you will see a lot of banks that are setting up desks that will issue these bonds. And to give you context on this, the global bond market is worth 135 trillion, and the global loan market is worth 226 trillion. Imagine what that would do to the market cap of crypto.
That's fascinating. Bonds are a perfect example to be on the blockchain, right? It's something
Absolutely.
to be on the blockchain, and just because of market pressures is finally pushing them to go digital because someone big finally did it. And so now
Absolutely.
all of them are pushing to do it, which is then probably push them. What's interesting is I've often thought about why are institutions not coming into crypto? There's certain safety rails that have to be there for them to do it in a big way, because
Yes.
what they found out with FTX is custody problems. If you sent money over to FTX, you had no guarantees. They weren't sending that money somewhere else. There was kind of like, oh yeah, trust us. But we see
Yes.
how that turned out. And so they are not going to send over all these funds to an exchange. If they do, it's going to be an extremely, extremely limited case, but they're not going to put $1 billion or $2 billion into a situation like that. But now you've created situations and are arranging situations so they don't have to. They can then put $1 billion or $2 billion into assets into a bank that they trust, that then they can trade against those assets. And if it goes against them, then the recourse is there to make it whole. And so it's a situation that massive institutions and sovereign wealth funds are going to be interested in. This is what they're looking for and been waiting for, so that they, an FTX situation doesn't happen to them, essentially.
Yeah, absolutely. I think this is the whole basis of this is when you speak to these fund managers and you say, look, what are your pain points? What are the problems? What are the issues you face? They will all tell you the same things. And we kind of sat down and said, okay, look, we could make a super, super fast, low latency piece of very smart tech that just matches prices. But we don't really fix any problems by doing that. The biggest headache a lot of fund managers have is really accessing the market. They all sit there because they're obliged to hold government bonds. But if they could then use them as collateral to trade crypto, that is absolute genius. And that's kind of, and by the way, I say this like we did this very quickly. It took us a hell of a long time to do, but we could offer this now. So we can do this.
You're an overnight success, 3.5 to 5
Yeah,
years in the making, right?
yeah, something like that. So we can do this, but and obviously, look, within reason. Obviously, U.S. government bonds, no problem. UK gilts because we're based in London, of course. German bonds, Japanese government bonds to begin with, and then obviously we may expand that to other G7. If you've got Greek sovereign debt, then yeah, good luck with that. But that's not us. So what we've done is we've made those pinch points much easier. And then on the other side of the coin, there's a whole bunch of crypto natives that need to do things, simple things like foreign exchange, they can't do because banks won't face them. So we're happy facing those counterparties because we have an existing FX business where we do over $1 billion in FX every single day. So having the crypto natives plug into us electronically is very easy. Doing fiat on and off is again very easy. We've got 16 banks we work with at the moment. Some of these guys are some of the biggest banks in the world. But the one weird thing, and this is a very strange situation, is if you look at the United States dominates every single bloody marketplace in the world. There's not an industry these guys don't dominate in America, apart from crypto, where ironically the US banks, apart from JP and Goldman's, who obviously are always ahead of the curve, they're a million miles behind the European banks. It's the European banks. So, for instance, Commerzbank today was the first bank in Europe to get a crypto license. Deutsche Bank about a month ago was one of the first European banks to get a custody license. This is a really interesting thing, and I can tell you that we're speaking to half a dozen European banks, and they're all very interested in pushing forward with market making in crypto. And again, the interesting thing about this is not because they're so interested in crypto; it's more to do with the fact that they will use this as a beta test to eventually trade digital bonds. And if you look at banks like SocGen issued the world's first bank-issued stablecoin on the Ethereum layer one. Now, okay, it wasn't great. It's a bit crap. I'll be honest. They've done a mediocre job. But the fact of the matter is, who would you rather trust, USDT or the second largest bank in Europe? And I think that's going to be another game changer for retail as well.
That was an avenue I didn't realize there would be pressure from. I didn't realize that a lot of their profitability came from bonds. That there would be pressures to then make their bonds digital and to keep relevancy. So now, because a lot of banks are required to hold bonds and treasuries, they can then use those as the collateral with a bank that they trust and then trade against that. Because some of the problems with institutions moving money into crypto is, number one, there isn't a spot ETF, and they don't want to send millions of dollars to some exchange to trade crypto. They don't want to custody the crypto because they would have to have 15 different board meetings just to approve who's going to custody and how. And so they're looking for solutions that they can easily trade in crypto without having to worry about custody situations, where even just the CFO or the CMO or the CEO can decide, I want to allocate 1% of our holdings in this and this and this over to, say, Bitcoin or ETH. But those roads for them to be able to easily do that without having to figure out how to custody it in a way that would be responsible weren't there. So what you're describing is a major road that makes it easy for them to have exposure to crypto, which they want, is now finalized or just about finalized.
Yeah, absolutely. And also look, so you're right. There is no spot Bitcoin ETF in the United States, but obviously Canada's had one. Canada's been very, very innovative. I've been really impressed with their regulator. The SEC, yeah, not so much.
Yeah, well, and it's good to have those kind of market pressures, right? One of the early experiments with the US was most of the things weren't passed at the federal level, at the state level. And so states had to compete within each other for relevancy. For example, when the automobile came out, well, New York City passed all these laws restricting this new technology because a lot of the politicians were in the pockets of the whip and buggy industry. horse buggies and whips and, all this related to horses. So they really ran on automobile manufacturing. So a lot of that stuff didn't get built in New York, it got built in Detroit, Michigan.
Okay.
And it created a massive hub there. But as the US has gone more federal and, the SEC has essentially made crypto, the US a very unfriendly place for crypto. A lot of that innovation, Canada's like, okay, we'll step up to the plate. We'll figure out something good. London, this is giving London a lot of, London's been pretty smart about this. London understands financial instruments very well, and they've been innovating on a lot of this space, and it's pushed some other things to Singapore and to Dubai and other places to the US's detriment.
It has, but I think there's a bit of a misunderstanding here. So if you speak to the SEC and you ask the questions, which we have done, what you realize very quickly is they're not so much anti-crypto. They seem to be more anti-crypto native, which is, I guess, a different kind of problem. So this is why you have, on the one hand, the SEC taking legal action against Coinbase, and Binance is political, so that's slightly different.
Yeah, Binance is just political.
100% political, because I suppose the CCP have a large equity size, which is not great. But then by the same token, you look at EDX, which I thought was some kind of erectile dysfunction medicine, but apparently it's an exchange run by Fidelity. That got a license. So you look at it and think, well, how is this any different to Coinbase? The reality is different because of the people that are backing it. That's it. So I think when you look at it through that lens, what becomes quite obvious is that there is eventually going to be an inflection point. I think when you have the critical mass of banks that are issuing digital bonds, you're going to have a huge change of mindset, because bonds are already regulated. They're already securities. There's no ambiguity. There's no confusion. Is this security or not? Yes, of course it bloody is. And that, I think, is going to be what drives the SEC to begin to make some actual proper sensible decisions. At the moment, I'm confused by some of the logic and rhetoric they're using. It doesn't make a lot of sense. And hey, if they want to kick a $1 trillion industry to the UK, I am more than happy to embrace that with open arms.
If they continue going the way that they're going, they're losing political pressure by their losses in the court, because, like you said, the judges are having a hard time understanding their thought process. And, one judge recently called it capricious and arbitrary, which seems to be, from what I know. Maybe there's things I don't know. In fact, Gary Gensler from 4 years ago doesn't seem to have anything in common with Gary Gensler from today. And that creates another confusion point.
But I think it's one of these situations. I think, look, I still, when he actually got his role as chairman of the SEC, I was extremely excited. I think I texted my friend saying, this is a game changer.
Crypto, this is going to be great.
Yeah. But it's like these things. He probably got into the political office and said, hey, buddy, this is the party line. And if you don't like it, there's the door. So he did a 180.
Some kind of instructions. Here's what we need you to take. Yes, it goes against everything you just said 6 months ago, but this is the route we need you to go, because regulators are often politically influenced by whoever appointed them. And the rumor is that Elizabeth Warren is the one that got him appointed. We know how Elizabeth Warren's take on crypto has been. So they seem to be very aligned. And so maybe there's some truth to that. I don't know. It's somewhat confusing. But, there's other people at the SEC that don't agree with the direction the SEC is taking. Yeah. And the courts are straightening out some things. And that's why courts are there. If the regulators seemingly acting unfairly or their arguments don't make sense, then they often lose in court. And so far, that's been what's happening. We'll see how that happens, but there's political pressure towards being more crypto friendly and embracing it. And the arguments of the SEC is, oh yeah, we just don't like the current players doing it. Who knows what it is. I think that there's pressure because crypto is a new way of funding, essentially venture capital. And so they want to declare it as a security, because if you're buying equity, essentially that's a security. So I get their point on going that way. Do I like it? Well, what I don't like about declaring everything as a security right away is it does cut out people who are not accredited investors. And I like the idea that not accredited investors can invest in early stages of projects, because that is one of the greatest ways to make wealth. At the same time, there are risks of losing the money. And sometimes regulators say, well, we don't want not rich people to be able to make decisions like that because they're not emotionally ready. And some people help make their point, because they then make losses sometimes because they bought at the right time or they bought some project that failed. and then scream that, oh my gosh, everybody scammed me. And you're seemingly making the point to the regulators that you shouldn't have been allowed to buy because you're not smart enough. I like a world in where people put their big boy pants on and they make decisions and they take ownership of them. And if you lose, you learn why you lost so that you lose less in the future, so that you can learn to make your money make money for you. And so I even see where Gensler and the SEC is sometimes coming from, though I don't think that that's the best approach, and declare everything as security and therefore off limits in the early days of investment until like some kind of initial public offering, which is when I think usually the very smart money is then exiting onto the public. But
Exactly.
it's not that you can't make money from the IPO forward, you can, but often the massive gains and also the massive risks, that period has passed. And I do like early stage venture capital investing.
Yeah, look, I think, look, I don't buy the rhetoric of this is about investor protection. I just don't believe that's the case. You know, I can go down to a casino in any part of London. I can spend all my money on black or red. That's
Yeah.
absolutely okay. But I can't invest in a business that I believe has potential because I've taken an educated guess that it may be one of the outliers. It's a nonsense. I think what the reality is that it's an asset class they don't fully understand. They see this as potentially a threat to the existing infrastructure. And
Yes.
now that banks are beginning to work out, you know what, this is another asset we can then sell to our customers and saying, actually, we should do this. Suddenly they're doing a 180, certainly across Europe. And I'm sure it's just a matter of time before the US does exactly the same thing.
Yeah, it's one of the problems of regulatory capture that over a while or after time, the regulators are in the somehow very aligned with those that they regulate. And the reason is because you don't make a lot of money as a regulator. And at some point, they're going to leave and want to work for these larger firms. And so they tend to often agree or look at the interests of the big firms. And in their mind, they're like, well, these big firms are more protective and stuff. And they kind of just see all the positives. And but this is why automobiles couldn't, like the automobile manufacturing didn't happen in New York. The regulators got too far in the way, so innovation was pushed to Detroit. And if you had an automobile in New York, you had to, this is where the idea or the red flag laws came about. You had to have somebody walk in front of your horseless carriage with red flags, waving them to be able to, because they're dangerous and automobiles can run over people, as if horses never ran over people. But that was just the current regulators being in line with who was paying their political contributions or who they wanted to work for, and being unfriendly towards innovation. And this frequently happens with the regulators. And so, like, you know, a lot of people scream, oh, yeah, we need regulators to protect everyone. There's probably too much regulation, probably too much regulatory power. I'd like to see less. I think that's generally better. There's a lot that disagree with me on that, but the current
No,
regulators
I think you're correct. I think that you hit the nail on the head. Here's the issue. You know, when was the last central banker that predicted a recession? You know, when was the last regulator that stopped people losing money? It's the same old shit all the time. Oh, this is terrible. We must do something. Well, why the hell didn't you do something before? You've been asleep at the wheel. So I think there's a degree of culpability that really does sit with them. And look, I'm not criticizing them. The system ain't perfect. I get it, but you know, let's be grown up about this. And there are a lot of issues and problems that you can fix. But what I've discovered myself, and we've spent a lot of time spending time, effort, a lot of money speaking to a lot of banks. You know, one of the most interesting things I discovered was, you know, people have this very naive thought in their head that Bitcoin is some kind of crazy private internet money that's used by money launderers, which is utter nonsense. It is the most trackable asset in the entire world. And once the compliance guys see this, they say, oh, okay, this is interesting. So you can see the provenance of the coin. Yes, I can. Unlike fiat, where I've got one or two transactions and then good luck.
Yeah, exactly. Like fiat, actual cash is what most money laundering and terrorism funding comes from.
Yes.
And so, like, flying billions of dollars to Iran by a US president is like, okay, that's going to go right into terrorism and money laundering. But then Bitcoin, like, only idiots used Bitcoin in the early days for that kind of stuff because it's so trackable. Once they discover your wallet address, they then can see every transaction you've made. So it's just a false argument that like it's used for money laundering. It probably was in the early stages before those people realized how trackable it was. Are there other ways around it? All those roads and ways around it are getting closed. All those doors are getting closed. So it's harder and harder for anyone to do any kind of money laundering through Bitcoin. Cool.
Yeah, no, I agree. I mean, if you look at the actual, the number one currency of choice of money laundering, it is the US dollar. And in fact, if you look at the Financial Action Task Force reports, the last report I think came out 18 months ago said that more than 40% of all the money laundering in the world happened onshore within the United States, which
Yes,
is an interesting stat.
it is. It is. I know. And yeah. Well, people are like, oh, our politicians are corrupt. Well, hasn't that always been the case? Hasn't been the case since like 3,000 years ago? Yes. And some politicians are, and some politicians aren't. And there is always some level of corruption in the system. And so it's like mechanisms, and yet technology still finds a way, and people still find a way. So is the system more corrupt than it's ever been? No way. Probably not even close to more corrupt than it's ever been. Are there some flaws in the system? Yes. Are there some politicians that are probably corrupt? Probably. But yet technology will find a way. Innovation still happens, and there's entrepreneurs and other people that put things together despite all that and make the world churn, and technology improves. And so as an investor, I'm looking for who are those ones that are building the bridges for the future. And Manu, when you were sharing with me this bridge that you've been building for the last number of years and how close to completion it is, that was really exciting to me. And I wanted my Rainmaker family to understand this, not just because of the bridge, but because DeFinity itself, what you're doing is pretty incredible. I've got your team here. Here's from your website. There we go. So obviously this is you right here, but some of your other teams, can you tell us a little bit more about Michael and Ashwin and the rest of your team?
Yeah, sure, cool. So look, all of us have a background in TradFi. So essentially, I spent 18 years working in various banks. Michael's background is low latency electronic trading. So he's worked for the New York Stock Exchange. He's also worked for companies like Gain Capital. Ashwin likewise has worked for, again, electronic trading pretty much most of his career. And then essentially Chris, who's our CFO, again, he spent most of his career in banking at a couple of UK banks also. So we're all markets guys. We all are very familiar with sales and trading. That's kind of what we've done pretty much our entire career. And so our expertise and our experience really is in traditional finance. And I became a big fan of digital assets and specifically Bitcoin in 2017 once I discovered why it was unique and what the USP was, because I kept hearing this is digital gold, which I didn't really understand. But once I realized that this was a mechanism that could be replicated across various asset classes, that was where the penny dropped. And I thought, wow, this is going to be absolutely huge. So as a team, our background is really in trading and sales, cross assets. So again, I've got experience in inflation, also interest rates, commodities, but mainly foreign exchange. Chris is mainly fixed income. Michael and Ashwin are equities and foreign exchange. So adding a new asset class of crypto was reasonably straightforward, but there are differences. So for instance, if I do an FX trade and something has gone wrong, I've settled the wrong leg or something, I can unwind the trade, I can cancel it. The problem is when something is written to a layer one, all deals and all trades are final. It makes it quite difficult. So you have to have an additional layer of authentication to make sure that you settle the right number of trades. So that makes for an added degree of complexity. And I think that's where a lot of people have got very confused and they spend a lot of time and effort and money building a solution. We've got a very innovative solution that's very innovative, and it's something we've developed over the last couple of years. And I think one of the big things I'm keen to push is at the moment we have one European investment bank that is our partner. It is only a matter of time before we have 2 or 3 or 4 or 5. And look, we're speaking to half a dozen as it is. Once we have a critical mass or a cohort of, let's say, 2 or 3, some of these banks are already trading crypto. Not that this is in the public domain, but they will come out publicly and they will begin to announce this. So we will be one of the first platforms that they connect to get bank liquidity from. So at the moment, it's all non-bank market makers, the likes of Wintermute, BTC2, Cumberland, those kind of guys are kind of plugged in. They will be replaced very quickly with the banks because the banks have got balance sheets and they are very, very keen to get into this market. The second phase of innovation will be from the ultra high net worth / private banking guys. Already seeing it a lot with the Swiss banks. They're very active, very aggressive. This will change in the next couple of years, where you see many more banks come in with their ultra high net worth desks. So you're going to see 2 waves of capital come in. One is going to be the asset managers who are interested in buying and hold. by the way, my favorite kind of investors, because all they do is add quality to your market cap. The second phase is going to be the ultra high net worths. They may be buy and hold, they may trade, I don't know. It may be a combination of two. And then if you add to that, what will happen with the retail environment once you have, again, mainstream adoption of bank issue stablecoin, which I think is probably the better and safer alternative to central bank digital currencies, which I'm not a big fan of, then I think those three things happening in the next 24 months are going to be absolutely crazy. And they are going to drive the bull run. Obviously, we have the halving next year of Bitcoin. That is a huge milestone. But I think 2024 is going to be huge for Bitcoin and crypto in particular. And I think you're going to see genuine mass adoption.
Agreed. I think 2024, just because all these roads are being built and these bridges will finish late this year, or many of them early next year or mid next year, and then the money will start flowing in. And as money starts flowing in and the prices rise, just attracts even more money.
Absolutely, absolutely. And I think the other thing to really think about here is that you have a lot of people spending huge amounts of capital on looking at how they can deploy and implement various blockchains. Now, again, I'm obviously a bigger fan of public blockchains, not so much the private ones. I think that's a bit of a false economy. If things develop the way I believe they're going to develop, then we're going to see utilization and utility of a whole bunch of these layer ones go absolutely parabolic. Who's going to win the race? I don't know. I was really hoping it would be Cardano. I've been disappointed. I was then backing Solana, but Jesus Christ, the number of outages those guys have, I don't know what to say. And I come back to ETH, and I'm like, okay, maybe it's back to the guys who I thought were going to win.
It'll be interesting to see how that plays out. I'm a big fan of Cardano as well. They are not as good at the sizzle as Solana is, but they are really good at the function, right? Because they have they even had a single outage? There's been some hiccups with double settlement. Like there's a double settlement problem that they identified, in that people have to figure out what order to settle things in. And they knew that would be kind of a challenge to be solved. But I think Cardano was built in a very, when I took some computer science classes, they talked about architecting it all out before you wrote a single line of code. And almost nobody did that. But when you did do that, it always went way better. Your program was way better. It actually took less time to build it, and everything functioned well. And Cardano went that route, which up front is very slow and frustrating for the community. And that, I remember last bear market, it was my #1 pick, and everybody was complaining, calling it Cardano and vaporware, and that would never happen. And then it went 200x from the bottom. So all those people lost that argument, let's just say. Will it be the biggest chain in the future? I don't know. That's a hard competition, right? Solana made some really big improvements that I did not expect. Does it deliver though? I don't know. I mean, they're like, oh, we could do 50,000 transactions per second. Oh, by the way, as we got nowhere near that, our whole chain shut down and failed. So it's still kind of like the playground, the Wild West, kind of almost like the jungle. And the jungle is a very competitive place. And so we'll see who the big winners are.
But you know, there's a question someone asked me the other day, which is a very valid question. I had to really think long and hard about this, which was, look, are we doing the wrong thing? Should we be having layer ones that can do 50,000, 100,000 TPS? Or should we be looking at layer twos? Are we using layer ones in the right way? And I was like, you know, I thought about this, and after a couple of minutes, I thought, you know what, that's a really interesting question. I haven't really thought about that. Maybe we're doing the wrong thing. Maybe our focus should be on scaling with layer twos, not having all singing, all dancing layer ones, which suddenly then puts ETH back as #1 potentially.
It's interesting, and that argument isn't figured out yet, because you can have ETH and then you can have multiples of layer twos off of that different games. So a good example is Immutable X, which for blockchain gaming, you need to be able to handle tons of transactions. And Immutable X can actually spin off separate chains essentially for the different games themselves, so they don't even clog Immutable X as a layer 2. So it's kind of like having a layer 2 that doesn't get clogged that way, and then it all can be, whenever it makes sense, rolled up to layer 1, or you can export whatever back to layer 1 when you're ready. And of course, ETH costs are higher, so you only do that when it's needed. And that might end up being the solution that wins in the future, because ETH has the most traction. And so it's unclear. Could Cardano benefit from layer 2s off of Cardano? Probably, because at a certain point, Can you build a layer 1 that can do, well, I know of a layer 1 that can do 8 million transactions per second. And at that, they don't have a token released yet. They've been building for like 6 years now. They've actually had, is it longer than that? They've actually been able to do 8 million transactions per second since like 2020. And most people don't even know of them yet.
Wow, that's incredible.
Yeah, 8 million transactions per second, and it's verified. Accenture came in because they were doing a deal with a Fortune 100 company, and they're like, what you say you can do, nobody can do. So they sent in the blockchain team from Accenture for 2 weeks to verify that it could do that. And they're like, holy cow, it can. And so they were able to make that deal happen. Yeah, but they haven't done a lot of marketing and other things on it. But the project itself is called Devio, DEVVIO. And their website is devv.io. So they can do 8 million transactions per second. And they're kind of going for the same niche that like Algorand is, where it's mostly enterprise level stuff. And as well as the blockchain gaming space, because when you can do that kind of transaction per second, and like Immutable X, they can spin off different nodes for different games. So that they, at some point, even 8 million transactions per second would get congested if you're not able to spin off different nodes. So what happens in the future? I don't know. ETH has massive transactions and adoption, and layer 2s off of ETH have massive adoption. That might be the way that ultimately wins. Might be an idea like Cardano. My guess is that 3 to 6 end up being enough enough momentum that they're around long term, and there will just be bridges between them. It's probably how it comes together.
No, I agree. Just on your comment about blockchain gaming, look, I think this is huge, but I'm still kind of torn between, if you look at the where we are in terms of graphics versus say a Fortnite. I mean, you get the level of blockchain gaming up to that kind of level of quality. This is a gold mine, an absolute gold mine. And there's no regulation to get in your way. There's no rivals, i.e., banks, to get in your way. I really think blockchain gaming is going to be colossal if they can get the graphics to actually bloody work. It's still like 1990s for me at the moment.
Yeah, on a lot of stuff that's out, it's very simplistic. The better stuff is coming out soon, where it will be close to the higher levels. I think this idea of assets and truly owning your own assets is what's going to revolutionize blockchain gaming, because I think this idea of owning your own assets will by itself bring a bunch of money in, but there's another layer beyond that. So bear markets can be really boring. And so last bear market, I thought, well, I'm bored to death. I'm going to actually see where MMORPGs are. So I played like Black Desert Online, which was a pretty interesting MMORPG. I Googled like, what are the 10 biggest blockchain or MMORPGs? And of course, World of Warcraft was still number 1, but I was like, I don't really want to play World of Warcraft. It's just way too in-depth. I played Black Desert Online and a few other ones. I played again EVE Online, something I had played EVE Online in the early days of it, like 6 months after it launched. I got started in back in 2002, 2003. And I made actually about $7,200 playing EVE Online back then, because I would sell my in-game currency and some other things from the game. I would sell them on eBay. You weren't supposed to do that, but they didn't really enforce it, and they didn't put you on the naughty list if you did that. And eBay didn't have a problem with it at the time. So then once somebody bought it, they would just send me their character name. And if it was an item, I'd set up an escrow at a safe port for them to come pick it up. And if it was currency, I could just literally transfer it to them in game. So over a period of about 18 months, I made $7,200. I was like, this is amazing. But then they blocked all the roads towards that.
Yeah.
They're like, you can't do that. And now we're going to enforce it. Well, crypto has allowed that to be encouraged again, because that was there. It's been there for 20 years. Because what are you really selling when you're selling items in video games? You're selling the value of time. Yeah. And so I was able to, I got really skilled at being in very risky environments, so I could make massive amounts of money while mitigating my risk, way more than most players in the game could. I could then sell that money for real life money at a value that made pretty good sense to me. And it saved, say, the average demographics for that game was somewhere between the ages were 28 to 55. And the average income of the person who played that was $78,000, which at the time was
Shit.
even more money
Wow.
than it is now. And that's not a tiny bit of money now. And so that's why the value of people's time, like I had one friend that played the game with me. He made in his day job $750,000 a year. And yet he
Wow.
put in 20 hours a week playing that game because he loved it. So the value of like some doctor who played that game and they could just buy a bunch of currency rather than grinding 100 hours to get it, and they could buy that currency for say $100. Oh, they'd make that trade all day long. And so you'll see that with blockchain gaming now, that asset ownership and exchange of value is encouraged. And game makers didn't want to have to go this way, but they're going to have to go this way to be competitive. There's also a secondary thing that I noticed when I started playing EVE Online again in 2019, 2018, 2019, was that there were corporation owners that had built these massive corporations. And I heard somebody sharing with me, they're like, well, it may be that the corp, because I was like, how do these guys put in the time for this? And he said, wink, wink, it may be that they found a black market to sell some of the assets, some of the, currency that they generate and some other things that they actually make really good money managing these things, like real good, real life money. And I was like, so imagine once ownership and everything is embraced and this exchange of value is embraced, there will also be people within video games, like business people, like CEO level people that come in and run corporations within MMORPGs that are on the blockchain, that literally from their in-game money that they're making will be making millions of dollars worth of US dollars for their positions in video games. And it will also bring business into this space, because as they go further this way, there will be people that create things inside of metaverses or inside of big video games where they say get a license from the business to make ships. There's certain boundaries that they can make them in, but they do all the design and everything, and then they sell those and they make revenues from that. And so you'll see businesses within businesses, and that's going to change gaming for forever. In the future, it won't be called blockchain gaming. It would just all be called gaming, but almost all the games that are played will have asset ownership, like what blockchain brings.
So that's a really interesting point. I spoke to a friend of mine who's a research analyst for an investment bank, and I was, we're having a chat about Disney, which certainly over the last couple of years has really lost its way, I think, as a business with some of the ideology and the nonsense they've adopted. So I was looking at this and I was like, look, I'm not particularly bullish on this. And he said, no, I disagree. I'm very bullish. They're just going to change their model. So his explanation was really interesting, which is, look, what's going to happen with Disney is it's all going to be about the movie franchises they own. It's all going to be building rides and experiences of those. And now, obviously, if you add to that about, let's say, the Star Wars franchise, again, some of the questionable movies they made, I don't know what they were smoking, but that's not great. Still a great franchise. What if they expanded that aggressively into a metaverse or other things they've purchased? So like in the same kind of ilk where they can take that and scale that. So I think that's a really interesting angle. If what he's saying is correct, I don't know whether it is. This would be absolutely colossal, I think, for blockchain gaming as well.
Yeah, and this idea of asset ownership. And what's funny is I talked to my uncle. My uncle was part of the PC revolution from mainframe to PC, and he was one of the head people, I think, over at Lotus, like the chief programmer or in charge of that, like really brilliant guy, like genius. But not only genius, he could explain really different arguments in a really, like, he could break it down so that anybody could understand it. So he could make complex ideas understandable by anyone, which is another level of genius on top of being as smart as he was. And he said, this is 2015. He said, in the future, there will be video games, where they allow businesses, and he didn't know anything about blockchain at the time, they will allow businesses to build within them. So there will be like ship manufacturers and other things within their greater MMORPG. And that will be the way of gaming in the future. And that the overall licensor of the game just makes a small fraction as these businesses within them make a ton of money. And the game maker won't be the only ones creating amazing things that the gamers want. And so they'll be able to give gamers more of what they want through these little experiments that are going on within their greater ecosystem. And at the time he was talking to me about this game called Star Citizen, which had been in development for 3 years. It's still in development. It's probably the game that's had the most funding on its development in all time. I think they're getting up to 700 million or 800 million for
Wow.
this video game, and it's quite amazing what it can do. What's funny though is because they started development in like 2012, I don't even think it's going to be done maybe in a year or so, and you can actually play it by downloading. You get access to play the alpha, but you don't get to keep your stuff as they do the server resets. It's going to be interesting because if it's not blockchain enabled, it probably will get completely irrelevant. So they still have some time, but I don't even know that they're looking to enable blockchains. But their ideas are pretty good, and they spent all this time on it. I think the game of the future, and at the time that was the one he thought might go that way. But blockchain further enables what he was discussing, because running things on the blockchain and having things be able to settle in ETH or whatever the crypto is creates a currency that people can exchange value in really quickly, really easily. And like Axie Infinity, which is a fairly boring game. I don't know if you've ever played it.
I have, yes.
But their model was massively successful in that they allowed most of the value creation within the game to be by game players who were doing the breeding by buying Smooth Love Potion or earning it and then doing the breeding. And Axie Infinity just took a small transaction tax, 4.25%. And they made over $1 billion in revenues off of that transaction tax, which was amazing.
So effectively in that scenario, the developers effectively taking the role of a government.
Yes. Isn't that crazy? And it made them super wealthy. That's kind of a risky proposition to take, because what game makers like to do is they like to sell you the Smooth Love Potion, right? Or they like to sell you a way that you can speed up how much you can earn per day. And say you pay $10 to double the amount that you can earn per day, or whatever. That's a revenue model they like because it's not very risky. Axie Infinity took a very risky model of, okay, we hope a lot of people transact on our thing. Otherwise, we're going to run out of funding money. Like, we're going to be dead in the water. But that model worked so well, they made over $1 billion in revenues, and most companies would die for $1 billion in revenues. Most games never get to that number. Most games are likely to make several million in revenues. Yeah, cool. Man, and we really appreciate you joining us and sharing. There's a lot of people in the crypto space completely unaware of this bridge that you were talking about, because most people in the crypto space don't have investment banking backgrounds. So they don't know what's been stopping institutions from coming in. They don't understand what problems are holding them back. And I appreciate you joining me today to explain how this, not only what the problem is that's been holding them from coming in, but how the solution or that bridge is getting completed through what you're doing at DeFinity. And so they'll be able to easily move money in and out in ways that they're familiar with and still feel safe with.
Well, listen, thank you so much for having me on, and pleasure speaking. And again, look, I think this is just the beginning of institutions coming into the crypto space. And when they really begin to make these announcements and you see some big names enter the market, get ready for one hell of a ride.
Yes, it's going to be like a tidal wave, and it's going to be crazy. It'll be like surfing a tidal wave.
Yes.
All right, Manu. Thank you so much for your time.
Thanks, Jay. Cheers. Take care.
Yeah, that was amazing. So if you haven't checked out, DEFX is DeFinity's ticker symbol. I mean, you can find them on CoinMarketCap or CoinGecko. I think you should strongly take a look, and we will see you all soon. Thanks, everyone.